All right, so this is lecture week 3, the first part of the lecture, and in this lecture we'll talk about the economic context of policymaking. There's a section here about the political context, and for that content I'll let you look at the Donald Lindhorst reading where he talks about federalism. That'll be the section on the political structure, but here I want to look at the economic context. That'll be my focus for this lecture. So first, let me just give you a quick outline of what I intend to cover. So first I'll start with some background, some basic definitions of economics, economic structures and such. And then we'll look at fiscal policy. And by fiscal policy, I'm referring to the government's taxing and spending authority. And then just a quick note on monetary policy. If you want more details about monetary policy, I would recommend that you take a macroeconomics course, but we'll just offer a quick note here. And then we'll take a step back and take a big picture approach and look at the relevance of fiscal policy, what we're talking about in the way of fiscal and monetary policy. That'll be the first part of this lecture. And then in the second part is where we actually get into discussing our very first policy, and that's the earned income tax credit. But even before we get there, we'll need to cover some more ground in terms of background terminology and such about how the federal tax system works. And so that'll be in the second part of this lecture. So first, we'll start out with some basic definitions. This is from your Dolgoff reading. And so this is Professor Dolgoff defining economics. He says it's a study of income, production, and distribution of goods and services. So I like this definition. It's really more of a definition of microeconomics as opposed to economics generally, but we talk about income here. So income, consumers, consumer theory, utility maximization, the extent to which consumers can maximize their happiness or satisfaction subject to some sort of budget constraint. That's a topic, that's the first topic that's covered in microeconomics courses typically. Production, the second part of this definition, this is referring to businesses trying to maximize their profits. So profit maximization is the second part of microeconomics courses typically. And then distribution or allocation of goods and services and resources. Welfare economics is the third topic that's typically covered in microeconomics courses. So I think a strong definition of microeconomics, not necessarily a definition of economics. There are a couple of concerns, major policy concerns for legislators and policy analysts for that matter, but they revolve around equity and efficiency. And so without getting into sort of deeper definitions of these terms, I'll just talk quickly about how these things are measured. So in terms of efficiency, the typical indicator that's used by policy analysts in the way of measuring efficiency, one measure is GDP, which stands for Gross Domestic Product, and that refers to the total value of all goods and services that are produced in a given economy within a given period of time. So that's one way in which we measure economic growth or efficiency. That is, if GDP is increasing or maybe not increasing, that's a measure. So we might say that we're in a period of recession where GDP is not increasing at all, or maybe even decreasing. That's how we characterize recessionary periods. And then we have inequality, or that's what Professor Dolgoff refers to when he speaks to the second criterion. But really, what we're looking at is equity, right? So one measure here, in terms of a measure of inequality, is a Gini coefficient with a number between 0 and 1. Numbers closer to 1 indicate greater inequality in a society, and then you have numbers closer to 0, which is just the converse. But one might argue that an unequal distribution, even if we have unequal distribution, that might be equitable or fair. So really the bigger picture is about equity, but the concern might be over the extent of inequality in a society is what I'm getting at there. So we characterize different economies. So given this definition of economics and of economies, we tend to classify different economies according to how much of productive assets are in fact privately owned versus publicly or government owned. So where productive assets are mostly privately owned, we call that more of a capitalist structure if we're thinking along a continuum. And where those productive assets are in fact owned by the government, we call that a socialist structure or sometimes a communist structure, not as relevant today in our society, but once a big method or social type of organization. Another way to think about it is where there are exchanges of goods and services. Are those decisions determined by private individuals, or are those decisions regulated to some extent by the government? In the former case, we have more of a capitalist structure, social structure. In the latter case, where those decisions are determined by some government structure, then of course that's going to be indicative of more of a socialist regime. So the practical matter here is that most nation states will fall somewhere along that continuum, with a strong case that can be made that the U.S. Structure is more towards a capitalist system than it is a socialist system. And we need not look any further than really just the healthcare industry. So if you look at all the spending that's done in the healthcare industry, you'll note that most productive assets or most spending is done by private entities. And so within that industry, we make the claim that in fact we're more capitalist or privatized in nature. So a simple case that can be made that we're more of a capitalist structure than a socialist structure here in the U.S. Using healthcare as the example, right? All right, so the important part of this section here is about fiscal policy. And I said before, fiscal policy refers to the government's taxing and spending authority. Right? Taxing on the one hand, or generating revenue on the one hand, and of spending that revenue on the other. And so when the government generates revenue, if that revenue exceeds the amount of spending that the government is engaged in, then we call that a surplus, right? We have a government surplus. If we're talking about the federal government, we have a federal surplus. If the amount of revenue that's generated is not up to par with the amount of spending that the government is doing, then we call that a deficit situation. So that, of course, characterizes our current economy or our current fiscal structure, where we're spending more than we're raising in the way of revenue, and so just sort of a characterization of the current state of fiscal affairs. And so where those two things approximate one another, if the revenue approximates the amount of spending that's being done, we say we have a balanced budget. So we're working towards a balanced budget in our current political environment. So of course, when we're thinking about revenue generating revenue and then spending that revenue, of course, there's different ways for governments to do so. And on the revenue side, it's not only with respect to taxation that governments can generate that revenue. So you may have heard in the last election Mitt Romney talking about, well, he said, if we have to borrow money from China to fund that social program, then we should be cutting that program. That's a suggestion that we have other ways besides taxing to generate revenue, and that's borrowing. Right? Sometimes we borrow from other countries to generate the revenue that we need to run our programs. And then, of course, on the spending side, there's lots of different ways in which our government spends its resources. Of most concern to us is, of course, social spending on the programs that we care about. I don't know why in this section I always think about the movie Iron Man, but you notice the government is spending money on military weapons for Stark Industries, right? So different ways in which governments can generate revenue and spend that revenue. Now let's look a little more closely on the revenue generating side, and in particular we're looking at taxation, right? Taxing as one of the ways in which governments generate revenue, and we have different types of taxes. We have progressive, regressive, and proportional taxes. In the way of a progressive tax, what we mean there is that that type of tax, when income increases, right? And if you look at the structure, if the level of income increases, the rate of tax is also going to increase. And so one example here is our federal income tax structure. If you make more money, right, in our society, you're going to be taxed at greater rates. That's one example of a progressive tax. We have regressive taxes, and this is just the opposite, right? If as you increase the level of income, the rate of tax is going to decline. Now, the examples here are a little bit tricky. So a sales tax is actually an example of a regressive tax. I know at first blush you might think, well, everyone seems to be paying the same rate. If you're thinking about sales taxes in Chicago, for example, so you go to Nordstrom, and you buy a button-down shirt, you're going to end up paying 10%. Doesn't matter if I go in and buy that shirt or if Bill Gates goes in and buys that shirt. But the key here is that you have to take the tax and assess it as a percent of the individual's income, the purchaser's income. So 10% tax on a $30 shirt as a percent of my income is going to be much greater than that rate of tax on Bill Gates' income. And so we say that it's regressive. It's disproportionately, there's a disproportional effect on the lower income worker relative to the higher income worker, and therefore we call it regressive. Another example, gasoline. Let's say, well, so today I was on the way to school and I saw that gas is at $3.59 per gallon. So let's say the government imposes a tax, a $1 tax, such that gas is now $4.59. So that tax is going to hit me, the lower income worker, much harder than it does the higher income worker, the Bill Gates of the world. So we call it regressive in nature, whereas it might seem to be proportional or flat. At first blush, it's actually a regressive tax that has a disproportionate effect on the low-income worker relative to the high-income worker. So a couple examples there. And then finally, we have the proportional tax. That is, regardless of the level of income, the rate of tax is going to be the same throughout. So historically, Medicare was an example of a proportional or a flat tax, but that's no longer the case. So we had a 1.45% tax that was paid across all income levels, but that's changed. So now one of the examples that I give is property taxes, local property taxes. You're going to pay at the same rate no matter what level of income you have. It's just based on the property that you own. So this is from Dolgoff. Behind me you see a tax table. So rows run east-west, right? So we have three rows, three important rows, and they represent three different types of workers. You have the $10,000 worker, you have the $50,000 worker, and then you have the $100,000 worker. So columns run north-south. We have three different sets of columns. In the first column, you see here that the person makes, or the person pays $1,000 no matter the level of income, right? And so you'll notice that the $10,000 worker pays a 10% tax rate. This middle income worker pays a 2% tax rate, and then this person pays a 1% tax rate. This is an example. As income increases, the rate of tax decreases. So it's an example of a regressive tax, right? Based on what we've just talked about. So this middle column here, you see that the rate of tax, and the key is to look at the rate of tax, not the amount of tax that's being paid. So in terms of the rate of tax, you notice that the rate of tax is increasing from 15% all the way to 40%. So this is an example of a progressive tax scheme. And then this final column here is an example of proportional tax. It doesn't matter the level of income, whether you're the low-income worker or the high-income worker, they're all going to pay at 0.015%. So examples of progressive, regressive, and proportional taxes. Now, just a quick note about monetary policy, and this is referring to the government's effort to control the supply of money that's in our economy. The primary method by which the government controls that money supply is with the Federal Reserve Bank, the Federal Reserve banking system. And so it's a hierarchical structure. You have the Federal Reserve Bank at the very top of that hierarchy. You have 12 regional banks, as Dolgoff explains, and then you have the local banks. And the federal government will control the money supply with what are called discount rates. By controlling the discount rates, the government controls the money supply. This is important because setting of the discount rate has effects in terms of inflation, in terms of unemployment. It's often thought that inflation and unemployment are inversely related to one another. That is, where there's a lot of money floating around, right? People are spending at will, businesses are thriving, and so typically the business is doing well, there's a low rate of unemployment, and vice versa. There's an inverse relationship. If people aren't spending money, the money supply is low, businesses aren't doing well, they have to lay off workers, and so unemployment is high. So you can see how the setting of this discount rate might have an impact on unemployment and inflation. So we note here that the setting of the discount rate is going to have a direct impact on consumer behavior. So whether people decide to save their money or borrow more money is going to be affected by this discount rate. You can imagine that where interest rates are extremely high, think about your credit card situation, where interest rates charged by your credit card companies are extremely high. There's an incentive there not to spend money, not to borrow more money, in other words, but where interest rates are incredibly low, which is what the government has done up until this point to try to stimulate the economy, you can imagine that there's greater incentive for people to borrow more money. Right? So this is how the government will achieve control of the money supply. All right, so I said at this point we would take a step back and look at the significance of this fiscal and monetary policy discussion. And this is all with an eye towards different philosophical approaches for the government in terms of stabilizing or stimulating the economy. So these are two different approaches that the government, these are philosophical approaches of thinking about how to best get the economy going, right? And so we have two different approaches here. We have the Keynesian approach and we have a supply-side approach, and they have different ways of thinking in terms of what to do during crises, for example. During the Great Recession era, what was the government to do, right? That's the thinking here. There's two different approaches. And so first we move to the Keynesian approach. The basic idea behind the Keynesian approach is that government shouldn't just sit back during times of crisis during times of economic crisis and let the invisible hand of the market work itself out. That's not the role of government during those crises. The idea here is that we need more government intervention, right? We need the government to pass stimulus packages. If we're thinking historically in terms of FDR, we need more public works projects. We need the government to create more agencies like the Public Works, the Works Progress Administration, the Civilian Conservation Corps. We need more government involvement, is the idea during times of crisis. That's what Keynesians think, that we need more government intervention during times of crisis to stimulate the economy. Now, another approach, the antithetical approach, is from the supply side. It's supply side thinking. So the idea here is that during times of economic crisis, the best thing for the government to do is not to intervene more, but to start cutting taxes. So less involvement in redistribution is another way to think about it, to best stimulate or stabilize the economy. Now, you can think about what the logic might be. So the idea is that if you cut taxes, people have more money in their pockets with which they can go ahead and spend. And if the problem is with people not spending enough money and getting our economy going and increasing our economy, then that's what you want to do. You want to cut taxes, have more money in your pocket, right, at the consumer level and stimulate it this way. Now, you may have heard of trickle-down theory back in the 1980s. This was characteristic of the Reagan administration. The idea was that if the administration cut taxes on corporate entities, on corporations, then of course the profit margin would increase for the companies. And so with larger profit margins, the companies could lower the prices that they're charging on their goods. And so people would be able to better afford all the products that are being sold. And so you could stimulate the economy in that manner. So it would trickle down eventually to the level of a consumer. That was the thinking behind supply-side theorists during that era. So you may have heard of a trickle-down theory. Now, of course, Dolgoff notes this sort of moral objection to trickle-down theory, and that's if you have a government, if you have a presidential administration that's retaining the same level of spending, if the government is still keeping up the same level of spending and cutting taxes, you can see that that results in larger and larger deficits. And if those deficits are simply passed on to the next generation or the next president that comes into office, then you think, well, morally, I mean, what's the good behind stimulating the economy in this manner when you're just going to pass down the debt to the next generation? So there's a moral objection here to this line of thinking. All right, so that concludes sort of the background section for this lecture. And in the next part of this lecture, we'll look at fiscal policy and some background before we dive in to the nuts and bolts of the earned income tax